You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Lay what has happened, say, since the middle of February to now against previous bear markets. The only thing it compares to is 1929. And again, you've got to slow it down in order to make that comparison work. The speed with which this has hit is truly one of the most historic and sort of unprecedented things in market history. This is going to be a case study in the future of how, markets theoretically can fall.
This is Mining Stock Education, and I am your host, Bill Powers. Thank you for tuning in. On today's show, we're going to get a perspective of current events from a fund manager, Will Thomson. He is the managing partner of Massif Capital. You can find more information about Will and his fund at massifcap.com. That's MASSIF as in Frank, CAP.com. Will, thanks for coming on the show again. And for those that aren't familiar and haven't listened to our past few interviews, please describe how your fund goes about investing, and then how are you navigating your fund through this crisis?
Well, thanks for having me on again, Bill. So for those that don't know, Massif Capital is a long-short equity fund. We invest specifically in industrials, basic materials, and energy. The basic materials portfolio generally makes up anywhere from a third to a half of the overall portfolio, and it's primarily mining. Every once in a while, you'll see something else in there, ag-related or something, but principally mining. I just think from a sort of general philosophical perspective, we are sort of deep due diligence, value investors in granted cyclical spaces, but nevertheless value investors. Overall, I think managing the fund through the current environment is definitely a challenge. I think managing any portfolio at the moment is a challenge. Volatility of this sort of nature and this level can sort of make anyone look like an idiot. I think what we are doing is we are sort of sticking to our knitting, which is primarily, deploying capital on the long side into companies that we know very well with management teams that we know, and sort of being cautiously optimistic with that deployment. So, for us, we tend to run or are trying to run closer to market neutral with sort of equal longs and shorts, sort of coming into this year. That's how we were positioned. And so on the long side, we are occasionally adding to positions, adding a little 1% here, 1% there, but we aren't necessarily being particularly aggressive yet. There are what look to be some developing opportunities that are going to be fantastic. But I think there's still plenty of time to be patient. There's plenty of money to be made, if you will, by sitting on your hands during sort of current events, I think. And that's primarily because, the uncertainty level is so high that one definitely wants to find sort of the businesses they want to buy, but, sort of tiptoe lightly into them, I think. So on the short side, I would say we're definitely being a little more aggressive. We had a pretty significant short book coming into this and have continued to add to it here and there. We're still finding the occasional opportunity sort of to add to the short book, not necessarily in certain beaten down sectors like, say, U.S. fracking or something like that, but definitely still some idiosyncratic short opportunities out there specifically related to various different companies' business models. And again, more so on the industrial side of things, business models where, sort of access to capital markets is necessary for the survival of the business. Those are great sort of short candidates at the moment, in our opinion, and we're still finding them from time to time.
Will, the Dow is down, as you know, 30% off its recent highs just in the last 30 days. There's even blue chip stocks that are down 50%. gold stocks down 50% or more, depending on which stock you're looking at. So you also have the shorts that you mentioned. Did your shorts kind of save your portfolio here in the last 2 weeks and cause you to outperform at least the Dow?
We have a short book that has basically kept up with our long book. We also run a tail risk hedge via options. And between the short book and the tail risk hedge, we are up for the year. Although it's only a few percent, so it's not as if we're not a sort of tail risk fund that might be up a couple 100% because they have some sort of very leveraged option strategy. We employ the tail risk hedge to generate liquidity at the sort of bottom of cycles or during events like this, and thus far it has done that. And sort of between that and the short book, we're up a couple of percent.
There's been a lot of talk about the rush to liquidity and thus the strengthening of the U.S. dollar in the past 2 weeks. Did your fund rush to liquidity at all, or because you had these short positions, you're just staying put with the investments that you have?
The only way or the only direction capital has gone basically is out. So we have continued to deploy capital, as I said, patiently. But we did not rush to liquidity in the core portfolio at all. We do run a mining-only portfolio for a couple of people, a couple of our institutional clients and things like that. And I will say that there we have more juniors, pre-production mines, and we did liquidate a couple of those positions, not because we don't think that the companies are worth every penny that they're trading for, but because the potential for a pre-production, zero revenue mine, regardless of sort of the outcome or the near future, to fall to fall 90% or 75% is quite high, and so it was definitely a bit more of a trading decision than an investing decision. But sort of rule number one is don't lose money, and we saw it as an opportunity to get out of a couple of positions. But generally speaking, capital has just flowed into the market, not the opposite way.
Within the mining sector, when you are going to be redeploying more cash, what are some of the opportunities that you're going to be looking for, and what type of signals for an entry point could you share with us?
There's going to be a couple of different opportunities. I think the easiest and most sort of obvious opportunity is that there are definitely some majors, producers, and I haven't looked necessarily at, say, Rio Tinto or BHP, but sort of companies of that scale and size and expertise, et cetera, that are trading at prices that are too low. And those are, sort of good places to put capital, in our opinion, for the near future. For those that are looking for something a little more adventurous, I think, one has to be quite cautious, and one has to really focus on the near-term catalysts. So if you've got something, and I'm thinking something like, say, a Trilogy Metals, let's say, great, very interesting deposit, things like that, but they don't have any real catalysts in the near future. You can be really patient with something like that. That mine doesn't have a spade in the ground. It doesn't have funding. It's a long way off. But something, something more like an Adriatic, or, we like Equinox Gold quite a bit. So something with some more solid catalysts in the immediate term, where revenue is going to be turned on, cash flow is going to be turned on. Those are still opportunities that I think are well worth looking at over the course of the next, sort of 6 months. But I would be cautious, more cautious than usual, about juniors or developers that don't really have an obvious and hard catalyst. Not because there isn't value there, but just because of the potential for the money to sort of sit there for quite a long time before there's a pickup again. And keep in mind, these are things I think. I do not know them, but these are just sort of the impressions I have about the way the market is. That being said, I will say I observed this morning, and I think it's kind of interesting. Lithium Americas, which is a junior lithium producer, which we have a small position in, came out this morning and said they're going to have to put a halt on construction, and that'll delay the startup of their lithium brine mine by sort of into the first half of 2021. And despite that news, it is it's only sold off about 1% today. I'm not saying that necessarily means that it has bottomed as a stock, but that does sort of indicate to me that there is a reasonable, again, just sort of reasonable possibility that we've sort of hit a point for that individual stock that it's in strong hands, right? It's not in necessarily lots of retail hands who are just playing it for a quick pop. It's sunk to the point where it is at strong hands. Now, that's not necessarily true across the board for all juniors, but those I think are some of the signals that you want to be looking for, and the idea that we could see a pop here in a bunch of names sort of across the board is not unreasonable in the history of sort of bear markets. I assume we're in a proper bear market, or at the very least at the beginning of a proper bear market here. A bear market rally is to be expected. And so there are some potential interesting opportunities for more short-term trades, especially where you see a signal, at least in my opinion, like you might be seeing with Lithium Americas.
One issue I would take with your comments regarding Trilogy is that they have $92 million in the bank. They do have internal catalyst. However, it's not coming cash flow, and they are a sponsor of the show, so I am biased. But nonetheless, with $92 million in the bank, they do have a lot of sustainability, to where you get a lot of these juniors that they don't know where their next 6 months is going to come from. And so with a partner like South 32, with the management team they have, and at nearly $1 US, when 9 months ago the stock was at $3, I will say this about how I've observed for the last 2 years that stock reacts. If there is a turnaround and sentiment turns and people feel good about the economy, let's say in 6 months from now, that stock I would expect to be multitudes of where it is. So even from a trading standpoint, I think that it's good because you're not going to have dilution. The cash will last 3 years. And when they do come to a production decision, they have South 32, who is just rolling in cash to help them get into construction. So that's my one contention with what you said.
No. I first of all, I had no idea they were sponsored the show. I was just I'll be sort of contextualize what my thought process was there. I was just grasping for I think we've got a number of juniors out there right now that have potentially, these potentially wonderful, very large deposits. But they don't necessarily have a lot going on between now and, construction starting and things like that. There is this orphan period, if you will, as we all sort of know about, who follow sort of mining stocks. And it was by no means meant Trilogy specifically, just a lot, large deposits that are going to require a lot of capital and a lot of development time. One could point to something like Sol Gold, for example, or something. They're just big deposits right now where, there might be definitely a pause before things sort of pick up again, as opposed to things with more immediate catalysts. So I think that's the difference here in what we're looking for.
And Will, as you kind of assess where we're at, are there historical precedents? You like to read history. We were just chatting about a history book you read before we hit record. What historical precedents? Is it the Spanish flu of 1917 and 18 that caused the stock market crash and then a rebound? Or is this a 1929? I mean, any parallels you see here?
I hesitate to say this, but the only parallel at this point, we have taken a look at every bear market from the peak to the trough in the last, dating back to 1929 for the S&P and the Dow and things like that, and plotted it out to sort of look for some comparables to see what lessons we can learn. And unfortunately, although the, sort of the size of the fall, if you will, down 30%, down 36% for the or down. Let's see, where's the Russell? The Russell's down 36%. S&P 25, 30% for the Dow. That's not uncommon for a bear market. Frankly, it's, in my opinion, it's not far enough. But what is completely unprecedented is the speed. So the only comparable at this point is 1929, and it's only a comparable if you slow down how fast we've fallen. So if you look at the actual charts and you sort of lay what has happened, say, since whatever, the middle of February to now against previous bear markets, the only thing it compares to is 1929. And again, you've got to slow it down in order to make that comparison work. The speed with which this has hit is truly one of the most historic and sort of unprecedented things in market history. This is going to be a case study in the future of how markets theoretically can fall. And
we may not be done. I mean, do you think we can fall further? I think we can.
Oh, I don't see any reason why we don't fall further. I mean, I'm not going to try and pick a bottom point or anything like that. But if the real economic impact is as severe as it theoretically could be, we may see a pop in the middle somewhere, again, a couple of little bear market rallies. But if this is a bear market, the retracement that needs to occur for it to sort of fit with historical bear markets, we still got another, maybe 20% to go. That the 10-year run since 2008 has been dramatic. And the question is, what kind of retracement needs to occur for the market to settle down again? And I don't see any reason why a 40 or 50% fall like one sees in bear markets on a 10-year basis is out of the question.
So even with that, then, that potential expectation, you're not just rushing to cash. You're still sticking with some of your positions.
The idea of rushing to cash, you shouldn't be in the stock market. This is my opinion again, and this is what I think. I do not know this. If you're not prepared to take a 50% hit on a stock, then you shouldn't be in the stock. Companies rise and fall, but value doesn't change that much. And so we got plenty of stuff. We've got some oil stuff that's off, 50, 60%. You got a mining company that's down 70%. But if the thesis still holds, the thesis still holds. And so you have no reason to get out. And in fact, you have reason to buy. This market, people have to switch the way they're thinking about it. Again, patience is important, but things are on sale right now. And this is the only time anyone has a sale and people say, oh, I need to preserve cash, right? Nobody walks into Target or Walmart and says, oh, everything's on sale, I better not spend any money.
Your fund must have not been leveraged, though, because a lot of these funds that rush to cash, they were leveraged. So that's probably the difference?
That's probably absolutely true. Leverage is it's a two-edged sword. So if you are levered, then yeah, you definitely need cash right now. But cautious and sort of thoughtful portfolio positioning is quite important. So if you were levered to the long side, then yeah, you need to rush to cash. But I suspect that a lot of your listeners are not, levered portfolio hedge funds. And so those individuals should be, sort of patiently waiting, deploying capital thoughtfully, and not panicking, because it just it doesn't add any value to your process. You got to stick to your process regardless of the environment.
You've been listening to Managing Partner Will Thomson with Massif Cap over at MassifCap.com. Will, is there anything for our listeners that they should be aware of?
Feel free to sort of head over to our website. We provide our quarterly letters and occasional research reports and things like that. So if you're interested in signing up or learning more about the fund, you can reach us via our website.
Excellent. Thanks for coming on the show today, Will. I really appreciate it.
Absolutely.